Good day, Mom. Good day, classmates. We're the last group of reporters for these finals, and our topic is all about financial ratio analysis. But before anything else, before we move on to our main topic, which is financial ratio analysis, let's first define what ratio is. As per the module, ratio is expressed in a mathematical or expresses a mathematical relation between two quantities. Just like, for example, you have a whole pie which has 4 parts. It's divided into 4, so it has 4 parts. So when you take one part of that pie out of the 4 parts, that one part should be, when it is translated into fraction, in fraction form, it is 1/4. But when it is a ratio, you should divide the numerator by the denominator. So that 1/4 of the pie is, in ratio, is 1:4. But if you have to get the percentage, that 1/4 is 1 divided by 4, which is equal to 25%. So that is ratio. You have to take two numerical values, two quantities that are related with each other. But for financial ratios, the numerical values are taken from the financial statements, such as the statement of financial positions or the balance sheet, the income statement, or the cash flow statements. This is to have a meaning, or this is to gain meaningful information about a company. These numerical values, which are taken from the financial statements, are used to perform quantitative analysis and assess the company's ability which assesses the company's liquidity, the profitability, the marketability, the leverage, and its efficiency. Before we move on to ratio analysis, I would like to tackle about the 4 different kinds of financial ratios. Number 1 is the income statement ratio. In the income statement ratios, the two quantities or the two numerical values are directly taken from the income statement of the same period. Next is the balance sheet ratio, wherein the two numerical values or quantities are directly taken from the balance sheet or the statement of financial position of the same year or at the same period. Number 3 is the interstatement ratio, wherein you are going to take two numerical values or two numbers from either the balance sheet or the income statement and get their ratio. And lastly, number 4 is the trend ratio, wherein you're gonna take two numerical values with the same account, such as, for example, cash of 2012. You have to compare it to cash, or you have to get the ratio of cash from 2013. You have to compare the two cash of 2011 and 2012 from different periods. You have to get the ratio and the percentage of that two numerical values. Next, I have to enumerate the different financial ratios according to their categories. Number 1 is the profitability ratio, the liquidity ratio, the leverage ratio, the efficiency ratio, and the marketability or the market value ratios. These categories should be discussed by my group mates in the succeeding topics. So in this topic, financial ratio analysis, we define financial ratio analysis as one of the analytical tools that finance managers and financial analysts use to measure how financially healthy a company is. So in this topic, we would answer some questions like, How do financial ratios as an analytical tool help us interpret and analyze the company's financial position and financial performance, including the liquidity, the solvency, the profitability, and the leverage, and the market value of the firm? The next question that we have to answer in this report is, how are these financial statements based on ratio analysis can provide as a foundation for projecting the future of a company? Ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor a firm's performance. It is not only important that you know the formulas or the way to compute the ratios and how to get something like the turnovers, the percentage, the ratios, and how many times or how many times do your earnings before you can, how many times did the cash go back or the payables to be paid back to you or the receivables and how many days you're gonna collect it. But the most important is that you know how to interpret these results of the ratios for you to be able to analyze and monitor a firm's performance or a company's performance rather. If there are problems of the company, it would reflect also in the ratios or in the ratio analysis of a firm. Like for example, if the company is able to, or whether the company is able to pay back its financial obligations to its creditors, it can be seen or it will reflect in the ratio analysis. Also, whether the company is gaining profit or being profitable or not, it can also be seen in the ratios. So for us to be able to understand well the topics that we're gonna discuss in our report, we have to familiarize ourselves first with the financial accounts which are found in the balance sheet or the statement of financial positions, in the income statement, in the cash flow statements, and also in the statement of changes in equity, for us to be able to relate ourselves on the topic, to reflect on what are the significance of these ratios and why is it used and how important these ratios are in the financial analysis and reporting. There are three major uses of ratio analysis. First is it shows the financial strength and weaknesses and should be used with other techniques of analyzing financial statements. Syempre, pag nakita mo yung ratio niya is medyo hindi siya pasok sa ideal or sa standard na ratio na dapat pasok siya, so makikita mo na ay may weakness yung company na to, parang ganun. Pag nakita mo na yung mga assets niya is hindi na nila kayang bayaran yung mga liabilities na, or yung mga financial obligations ng company na yon, mapapaisip ka na lang as an investor or as a creditor kung dapat mo pa bang pagkatiwala dun sa company na yon yung iyong pera, kung dapat ka pa mag-invest sa kanya or hindi na. So, number 2 is used for making plans for the future. Ratio analysis is used also for making plans for the future because ratio analysis can be a basis for any company in order for them to solve their present crisis. Like for example, kung yung company mo is may problema sa assets or sa liabilities niya, na masyadong malaki yung liabilities niya at hindi na siya kaya ng assets niya, pwede niyang tignan yung mga ratios ng iba't ibang different periods ng company na yon, kung ano ba ginawa nila, kung bakit ba dapat mas malaki yung assets nila kumpara sa liabilities nila, para maka-come up sila ng mga plans, strategies, and techniques para mas mapabuti pa yung kanilang company. And to gain more profit and also to gain more investors para maging isang win-win situation para sa lahat, na yung company hindi lang siya nag-gain ng profit na para sa kanya, pero kung isa siyang corporation or isa siyang partnership rather or incorporated, parang ganon, makikita rin ng mga shareholders nila, either preferred shareholders or common stockholders, na nagigain yung mga ininvest nilang pera dun sa company na yon. So, pag gano'n yung nangyari, yung trust and confidence ng mga investors ay mas lalaki pa at pwede na lang ipag-anyaya or pwede na lang iparating sa mga ibang investors na, yung company na to, malaki yung profit na nakukuha ko sa kanya. So, parang ganon. So, malaking tulong na rin yun para sa company dahil lamang sa ratio analysis. Number 3 use of ratio analysis is for performance evaluation. In here, evaluate nila yung company, yung performance ng company, kung paano ba nila minamanage yung mga assets nila or yung mga equity nila para makagain pa ng mas maraming profit. So, yun na naman yun. Pag nakikita nila na maganda yung performance ng company, mas nag-attract sila ng mga, hindi lang naman mga investors, pero pati mga customers na rin. So, pag ganun naka-attract sila, so, mas malaki yung kikitain ng company na yun. Okay, next topic. In the contrary, di ba, kakasabi ko lang kanina na isang use ng ratio analysis is para makagawa ng mga plano, making plans for the future. In the contrary naman, hindi mo magagamit yung ratio analysis para ma-predict yung future. Pero hindi mo siya ma-predict, kaya mo naman gumawa ng mga plano or techniques na ikabubuti para sa ikabubuti naman ng company mo. May mga ilang problema lamang sa ratio analysis. So, number 1 is the changing price levels. Like, for example, changing price levels. Kung ano yung, for example, equipment and machineries. Naipatayo yung company mo noong 2012. Bumili ka ng machineries and equipment worth 80,000 pesos. So, today, as of today, 2021, that machinery and equipment worth 80,000 pesos is not 80,000, do not worth 80,000 pesos anymore today in the fair market value. Kasi nga, diba, yung mga equipments and machineries is nagde-depreciate sila over time. So, yun yung problema sa ratio analysis. Yung ratio analysis niya noong 2012 ay hindi na siya gaya ng ratio analysis this year, 2021. Kasi yung value ng machinery and equipment na yon is nag-depreciate na siya. So, meaning bumaba na. So, yung ratio analysis niya is nagbago na rin. So, ito yung mga problems pag like sa yung mga assets na nagde-depreciate over time. Nagbabago rin yung mga ratio analysis nila compared doon sa mga hindi nagde-depreciate na assets like cash. Kasi syempre yung cash, kung 80,000 siya, 80,000 pa rin siya ngayon. Okay, my next topic is diverse underlying businesses. So, ang ibig lang sabihin nito, yung company na yon is may variety of product lines, may iba't ibang products siya or services, or either under siya ng pagbibenta ng products, and at the same time nagre-render din siya ng service. So, nagko-cause din ito ng problema sa ratio analysis because hindi mo pwedeng i-compare yung nagagastos mo sa pag-render mo ng service doon sa income mo or sa sales mo from your products. You cannot compare them. Pero in the long run naman, kahit hindi mo siya pwede i-compare, syempre magkaiba kasi sila ng like industry, pwede pa rin siyang maging source ng analysis mo when it comes to the gross profit margin, kasi ang kukunin naman doon is yung net profit mo naman or yung net sales mo. Kahit na dalawa yung business mo, it's either na-service ka or nagbenta ka ng products, pwede mo pa rin siyang pasok sa ratio analysis. Kaya nga lang, hindi mo siya pwedeng directly na i-compare. Kasi nga,
Good day, so I will tackle the purpose of ratio analysis. Based on the given module, through ratio analysis, the financial statement users comes into possession of measures which provide insight in the profitability of operations, the soundness of the firm's short-term and long-term financial condition, and the efficiency with which management has utilized the resources entrusted to it. So, through ratio analysis, it is used to evaluate a number of issues with an entity and compares line-item data from a company's financial statements to reveal regarding the liquidity, efficiency of operations, and profitability. At sa pamamagitan ng financial ratio analysis, ang layunin nito ay kumuha ng importanteng mga datos mula sa financial statements ng kumpanya at ilatag ito sa formulas ng ganon ay makuha ang pagkakaiba nito sa ibang kumpanya each quarter. So, financial statements are the report card of the business. At makikita ang difference nito sa performance at estado ng kumpanya sa mga competitors nito sa pamamagitan ng ratio analysis dahil naihahambing ng ratio ang dalawang magkaparehong estado ng business gaya ng net sales, total debt at iba pa. So the purpose of ratio analysis is to evaluate the financial performance and stability of an entity. So let's proceed to limitations of financial ratios. First, ratios must be used only as financial tools, that is, as indicators of weaknesses or strength and not be regarded as good or bad. So this means that ratios must be used as financial tools. This means that they are not conclusive but merely indicative of something about a company or firm. Second, the financial ratios are generally computed from the company's financial statements without adjustments. Conventional financial statements prepared in accordance with the GAAP have a number of weaknesses that managers must consider if the ratios are to be meaningful. So this means that financial ratios are generally computed directly from the financial statement without adjustments. Third, the ratios are composite of many different figures. Some are covering a time of period, others an instant time, and still others representing averages. So ratios are composites of different figures, some covering a single accounting period, some more than accounting period, and others an instantaneous period in time. And lastly, the ratios to be meaningful should be evaluated with the use of certain yardstick. And in order to be meaningful, ratios must be evaluated with the use of certain yardsticks or standard, and this may include the following. The most common yardsticks: first, the company's own experience, other companies in the same industry, a standard set by management, and lastly, the rules of thumb. And for the standard for comparison, ratio analysis can mark how a company is performing over time while comparing a company to another within the same industry or sector, and offer a useful insight into a company to obtain a broader picture of a company's financial health. And examining your financial ratios is one way to assess your financial health and discover areas where it might be improved. They provide essential information like if you have too much debt, too much inventory, or are not collecting receivables quickly enough.
Hi everyone, I'm Jesarela and I'm here to report the analysis of liquidity or short-term solvency. First is current ratio. What is current ratio and what is the formula in getting current ratio? Ratio that is widely regarded as a measure of short-term debt paying ability, a measure of the ability of the company to pay its short-term liabilities out of short-term assets.
The formula in getting the current ratio is total current asset divided by total current liabilities. For example, the total current asset in 2013 is 32,923 and the total current liabilities in 2013 is 13,730.50. So let's compute 32,923 divided by 13,730.50. The current ratio will be let's round off to the current ratio will be 2.40. So let's try to compute the current ratio in 2012. Same formula. So the total current asset in 2012 is 28,132 and the total current liabilities is 10,216. So let's compute 28,132 divided by 10,216. The current ratio will be 2.75 in 2012. So Glam's current ratio indicates that the year-end 2012, the current ratio year-end 2012, the current asset covered current liabilities 2.40 times down from 2011.
Second is quick or acid test ratio. This is designed to measure how well a company can meet its obligation without having to liquidate or depend heavily in its inventory and receivables.
The formula in getting the quick or acid ratio is equal to cash plus marketable securities plus accounts receivable divided by total current liabilities. For example, in 2013, the cash is 2,030.50 plus the marketable securities is 2,636 plus the accounts receivable is 4,480 divided by the total current liabilities is 13,730. First, let's compute the cash, marketable securities, and the accounts receivable. The cash is 2,030.50 plus the marketable securities is 2,636 plus the accounts receivable is 4,480. So the total is 91,465. So let's divide to 13,730.50. So the quick or acid ratio will be 0.67. Same formula if you get the 2012, the cash is 1,191 plus 4,002 plus 4,175. So 9,368 divided by 10,260. So divided by 10,260. So the quick or acid ratio in 2012 will be 0.92.
Third is cash flow liquidation. Considers cash flow from operating activities from the statement of cash flow in addition to the truly liquid assets, cash, and marketable securities.
The formula in getting the cash flow liquid ratio is cash plus marketable securities plus cash flow from operating activities is divided by total current liabilities. For example, in 2013, the cash is 2,030.50 plus the marketable securities is 2,636 plus cash flow 5,012 is equal to 96,785 divided by the total current liabilities 13,730.50. The divided by 13,730.50. Check 13,000. The cash flow is 0.70 times. Same formula if you get the 2012. The formula is cash 1,191 plus the marketable securities plus the cash flow from operating activities divided by total current liabilities.
Next is the analysis of asset liquidity and assets management efficiency. An asset's liquidity is a function of how easily assets can be converted into cash, and asset management efficiency, also called efficiency ratios, are the key in analyzing how effectively and efficiently your business in managing its assets to produce sales. Efficiency ratios measures the company's ability to use its assets and manage its liabilities effectively in the current period. It includes the accounts receivable turnover, inventory turnover, and fixed assets turnover. First is the accounts receivable turnover. Accounts receivable turnover roughly measures how many times a company's receivable have been turned into cash during the year. It determines how quickly a company collects outstanding cash balances from its customers during an accounting period. It is an important indicator of a company's financial and operational performance and can be used to determine if a company is having difficulties in collecting sales made on credit. The formula for accounts receivable turnover is net sales divided by average accounts receivable balance. Average accounts receivable refers to the average amount of money that customers owe to your company throughout the year. To get the average accounts receivable balance, we need to add the beginning balance and ending balance of accounts receivable, then divide their sum by 2. Accounts receivable are considered assets, so you can find all the numbers needed for this formula in the balance sheet. Let's go through an example to better understand how accounts receivable turnover works. We're going to use the financial statement of Glams Incorporated. We have here for the years ended of December 31, 2013 and 2012. Please refer to your module, page 10 of module 4. Again, the formula in getting the accounts receivable turnover is accounts receivable turnover equals to net sales divided by average accounts receivable balance. First, we're going to compute for the year 2013 of Glams accounts receivable turnover. I already wrote the amount needed for the computation, but for us to better understand, iisa-isahin natin kung saan nga ba nanggaling ang mga amount na ito. First, we're going to compute for the average accounts receivable balance. Like what I said, to get the average accounts receivable, we need to get the beginning and ending balance of accounts receivable. For the beginning balance, we have 4,175. We get 4,175 by subtracting these two. The accounts receivable, which is 4,383.50, and the allowance for doubtful accounts of 208. For the ending balance, we have 4,480, and to get this one, same procedure, we need to subtract the accounts receivable and the allowance for doubtful account. Next, we add up these two accounts receivable balances to get the answer, to get the sum of 8,655. Then we divide it by 2 and we get an answer of 4,327.5 average accounts receivable balance. After we compute the average accounts receivable balance, kukunin naman natin ngayon yung amount of net sales during the year of 2013, which is 107,800. Now we are ready to compute for the accounts receivable turnover. We already have the amount needed and nakaplug na siya. So 107,800 is the net sales for 2013 and 4,327.5 is the computed average accounts receivable balance. We divide these two and we get the answer of 24.91 times. This 24.91 times is not a percentage. This number shows how many times GLAM's accounts receivable turned into cash during the year 2013. After computing the accounts receivable turnover of the year 2013, we're going to compute also for the year 2012 to see if there is an improvement or none. We're going to use the same formula and the same procedure, but for the average accounts receivable balance, we only need the beginning balance. After we plug the numbers, we are now ready to compute. We divide these two and we get an answer of 18.32 times. This means that during the year of 2012, GLAM's accounts receivable turned into cash 18.32 times. This shows that the turnover of GLAM's accounts receivable into cash has improved from the year 2012 to 2013. So now, to evaluate the liquidity of accounts receivable and the firm's credit policies, we're going to use average collection period. Average collection period is also called day sales outstanding or day sales in receivables. It measures the number of days it takes a company to collect its credit accounts from its customers. The formula is average collection turnover equals to 365 days divided by accounts receivable turnover. For the calculation of average collection period, we have here two formulas that we can use. First is the average collection turnover is equal to 365 days divided by accounts receivable turnover, and the other one is average collection turnover equals to average accounts receivable divided by average daily sales. But we're going to use the first one. We need the days in a year, which is this 365 days, and the accounts receivable turnover, which what we had computed a while ago. Remember that we have accounts receivable turnover of 24.91 during the year 2013 and 18.32 during the year 2012. So I already computed the average collection turnover of GLAM's during the year 2013 and the year 2012. So we can see the difference. In the 2013, we have only 15 days, and for the 2012, we have almost 20 days. This indicates that during the year 2013, it took an average of 14.65 or 15 days for GLAM Incorporated to collect each invoice, while in 2012, it takes almost 20 days to collect. This computation shows that there is an improvement in the credit policies and is more efficient at credit collection. A higher receivable turnover and a lower number of days is better because this means that the company gets its money more quickly. So the faster the customers pay you, the better, because it is for your business cash flow and financial health. So the higher accounts receivable turnover but lower accounts collection period is better than lower accounts receivable turnover but have higher accounts collection period. Next is the inventory turnover. But before we go to its definition, let me define first what is inventories. Inventories are the raw materials, work on progress, and finished goods held by a business to enable production and meet customers' demand. Inventory turnover measures the efficiency of the firm in managing and selling inventory. In other words, it measures how many times a company's inventory is sold and replaced over a given period. This is used by analysts to determine if there are enough sales being generated to turn or utilize the inventory. Ratio is calculated by dividing the cost of goods sold by the average inventory. The cost of goods sold is the total cost used to create a product or service which is to be sold, while average inventory balance is the average amount of inventory available in stock for a specific period. So here is our formula in computing inventory turnover. So inventory turnover is equal to cost of goods sold, which we can obtain in the income statement, divided by the average inventory balance, which we can obtain in the statement of financial position. Our example is still on the GLAM's financial statement. For the year 2013, the inventory turnover is equal to 64,682, which is the cost of goods sold, and divided by 20,952.25, the average inventory balance. But how did we get this 20,952.25 average inventory balance? We get this by getting the beginning inventory balance and the ending inventory balance for the both year. We add the two and we get the sum of 41,904.50, and we divide it by 2 and we get the answer of 20,952.25 average inventory balance. So to get the GLAM's inventory turnover during the year 2013, we need to divide these two. So 64,682 divided by 20,952.25, we get 3.087 or 3.09 times. This means that during 2013, GLAM sell its average level of inventory 3.09 times. So for comparison, we're going to compute also for the year 2012. So I'll already put the amounts needed. So we only have to compute. So this 45,939.50 is the cost of goods sold, and 18,384.50 is the beginning inventory balance. So now we're going to compute. So 45,939.50 divided by 18,384.50 is equal to 2.49 or 2.50 times. So during the year 2012, GLAM only have 2.50 times in selling its inventory. This shows that from 2012 to 2013, GLAM's inventory turnover improves. The higher the inventory, the better. This means that the company is able to sell its products effectively and more sales are being produced.
I'm gonna continue the discussion on the analysis of asset liquidity and asset management efficiency, as the last reporter already discussed the three, which are the account receivable turnover, average collection period, and inventory turnover. Now I will discuss the average sales point?
In average sales period, it indicates how many days it takes on average to sell company's inventory. The formula in calculating average sales period is average sales period equals 365 days divided by inventory turnover. For 2013, average sales period equals 365 days divided by the inventory turnover ratio as the last reporter already computed, 3.09 equals 118.12 or 118 days. For 2012, average sales period equals 365 days divided by the inventory turnover ratio of 2012 is 2.50. 365 days divided by 2.50 equals 146 days. With this computation, we see that Clams Company average sales period decreased from 146 days in 2012 to 118 days in 2013. The lower average sales point is better because it shows that the inventory is being sold quickly rather than being stored. And now, let's move for the fixed asset turnover. And the next one is the fixed asset turnover. It's another approach assessing the management effectiveness generating sales from investment in fixed asset, particularly for capital-intensive firm. The formula in calculating fixed asset turnover is fixed asset turnover equals net sales divided by average net property, plant, and equipment. For 2013, let's see in the paybook of Clams Incorporated income statement, 2013 is 100 equals 107,800,000 divided by the average net property, plant, and equipment of 2013 is equals to 14,539.50 plus 9,488.50 and divided by 2. Now let's compute. 14,539.50 plus 9,488.50 equals to 24,028 divided by 2. Divided by 2 equals 12,014. 107,800,000 divided by 12,014 equals 8.97 times. Now let's proceed to the 2012 fixed asset turnover and the net sales of 2012
2012 is 76,500 divided by the average net property, plant and equipment is equivalent to 9,488.50. 76,500 divided by 9,488.50 equals 8.06. 06 times. The fixed asset turnover improved slightly because of the 41% increase in sales and compared with 53% of increase in average fixed asset. And it shows that fixed asset efficiency use it to generate revenues. And now, next to the last one is the total asset turnover, a measure of efficiency of management to generate sales and thus earn more profit for the firm. And the formula in calculating total asset turnover is total asset turnover equals net sales divided by average total asset. And now let's compute for 2013. Total asset turnover equals 107,800 net sales of 2013 divided by the average total asset of 2013 and 2012. The average total asset of 2013 is 47,649 plus 37,954.50 divided by 2. 47,649 plus 37,954.50 equals 85,603.50. 85,603.50 divided by 2 equals 42,801.75 107,800 divided by 42,801.75 equals 2.5185 or 2.52 times. And now let's proceed to the 2012 total asset turnover. Net sales of 2012 is 76,500 divided by the average total asset of 2012 is 37,954.50. 76,500 divided by 37,954.50 equals 2.01557 or 2.02 times. For glams, the total asset turnover has improved primarily because of the improvement in the fixed asset, inventory, and account receivable turnover. As we compare on the two different total asset turnover, the 2013 has 2.52 times, while in 2012 is 2.02 times. And the total asset turnover ratio helps how to determine if your business is productivity or not. And by the analysis of asset liquidity and asset management efficiency, it can help your company to let management how the business is doing and how many profits you can earn from your business, and how it generates sales from the given inventories.
Operating efficiency and profitability. Gross profit margin shows the relationship between sales and cost of products sold. Measures the ability of the company both to control costs and inventories or manufacturing of products and to pass along price increase through sales to customers. Gross profit margin, ipapakita na no kasano ka-profitable ni business and how the company manage well the business in order to generate revenue. And gross profit margin expressed as a percentage of sales. First, we need to compute the gross profit. Formula: sales minus cost of goods sold is equal to gross profit. Example, 2013 and 2012. The sales of 2013 is 107,800. In 2012, 76,500. Cost of goods sold in 2013 is 64,682. In 2012, 45,939.50. So, pag minusan tayo ni sales, kini cost of goods sold is equal to 43,118 in 2013. In 2012, 76,500 minus 45,939.50 is equal to 30,560.50. So, i-apply tayo J formula ti gross profited. So, formula gross profit margin is equal to gross profit divided by net sales times 100%. In 2013, our gross profit is 43,118 divided by our net sales in 2013 is 107,800 times 100% is equal to 40%. Isunod pa dato iti gross profit marginen in 2013. In 2012, our gross profit is 30,560.50 divided by our net sales, which is 76,500 times 100% is equal to 39.95%. Then, dito nukwamit ti gross profit margin in 2012. Glance gross profit margin for both 2013 and 2012 have been stable, which is considered a positive sign even if the company had to offer probably discounted items to attract customers or future sales to hasten up inventory turnover. Operating margin, a measure of overall operating efficiency and incorporates all the expenses associated with ordinary or normal business activities. And operating margin represent how efficiently one company is able to generate profit through its core operations. First, we need to compute the operating profit. So, muna nga example tayo, ti gross profit ket 43,118. So, let's say, the total expenses tayo ket 33,496.50. So, pag minusan tayo, 43,118 minus 33,496.50 is equal to 9,621.50. So, no kaya ito tayo operating profit. So, i-apply tayo ti formula na ket operating profit margin is equal to operating profit divided by net sales times 100%. So, the operating profit tayo ket 9,621.50 divided by our net sales, which is 107,800 times 100% is equal to 8.93. Last is net profit margin. Measures profitability after considering all revenue and expenses, including interest, taxes, and non-operating items such as extraordinary items, cumulative effect of accounting change, and etc. First, we need to compute the net profit formula. Total revenue minus total expense is equal to net profit. Our total revenue is 8,540 and our total expense, let's say 3,843. So, pag minusun tayo is equal to 4,697. So, no kaya iti net profit. Then, let's apply formula of net profit margin. Net income or net profit divided by net sales times 100%. So, net income tayo ket 4,697 divided by our net sales is 107,800 times 100% is equal to 4.36%. Isuno ka dito iti net profit marginen.